Hundreds of billions of dollars are at risk in Canadian pension funds as the commercial real estate market absolutely collapses. We're going to get into all of this, what's going on, and how it's the next global financial crisis in the making. Real estate bets gone wrong royal. 1.24 trillion Canadian funds. So you're probably thinking, oh, Luke, this is probably some private pension funds that I've never heard of. Not Canada Pension Plan. And believe me, unfortunately, it gets a lot worse than just this. As I'm going to get into, I discovered something from CPP's website, which is just going to blow your mind because this is going to cause a next global financial crisis. So the largest fund, Canada Pension Plan Investment Board, lost 5% on its property portfolio in the last fiscal year as the commercial real estate slump deepened. For the public sector pension investment board, the pain amounted to a staggering 16% loss on those bets. The worst fiscal year performance for those investments since the global financial crisis. With the property market upended by higher borrowing costs, Canadian pensions, known for their massive real estate businesses that were the envy of the investing world for years, are feeling the sting, and it's leading at least 4 major funds to now drastically retool their operations. And you know what? It's not just commercial real estate when it comes to it. In fact, even this article, which comes from Remax using Bloomberg data, you can see here housing represents nearly 40% of Canada's GDP, and it's actually over that number right now. So just trading property back and forth in Canada is 40% of the economy. It is just mind-blowing how bad that really is. So anyway, what's worked famously well for the last 35 years may not work so well for the next 5 to 10, Joe Taylor, Chief Executive Officer of the $248 billion Ontario Teachers Pension Plan, said in an interview at Bloomberg Toronto's office. And we know that Ontario Teachers Pension Plan has gone into more risky investments since the global financial crisis. We know, for example, that they are part of this Canada Guarantee, which is a subprime private mortgage insurer. So it's people who could not traditionally get a loan insured by CMHC, who are putting minimal amounts down, that they then go and insure those risky garbage mortgages. So just remember that. It's very interesting that they bought that guy on. So anyway, the second largest Canadian plan, Caisse de dépôt et placement du Québec, lost 6.2% on real estate bets in fiscal 2023. The worst since the pandemic hit 3 years earlier. In January, the fund said it would combine that real estate business with another specializing in lending against properties. That sounds really, really stable. A merger that's expected to save the plan $100 million annually. And then basically you can see the real estate assets that they have here on the left, and you've got CPPIB, CDPQ, OTPP, Ontario Teachers Pension Plan, obviously, PSP, and OMERS, and you can see the returns on those assets. So those assets are in deep trouble, and this is just not a good thing because there's a whole derivatives market that has been built on the back of commercial real estate that largely people are completely unaware of right now, and we're beginning to see the cracks emerge in that sector of derivatives that will eventually lead to a global financial crisis. It's like the same movie, The Big Short, on repeat. It's just for commercial real estate instead of residential. Now imagine that you were back in 2008 and Canada's economy was in the place that it's in right now, heading into that credit crunch environment. As well, we know that Canada is incredibly involved with this as well. Commercial real estate is a big thing in Canada. I know it's not something that generates that much interest, but it's so crucial and important to understand what's going on here. So the real estate sector is changing dramatically, said Jim Clayton, a professor at Toronto's York University. At the same time, we now have this structural shift in the way we work and live, which has sped up post-COVID. So I think you have people really rethinking what real estate is. I mean, yeah, the landscape has changed a lot. So I want to go over to Canada Pension Plan and show you what's going on. So Canada Pension Plan Investment board and Sound Point Capital Management formed partnership in CLO equity. Now, CLOs, essentially, if you've ever seen The Big Short, Margot Robbie is in a bubble bath and she explains basically what a CDO is. And basically, a CLO is just a CDO, which they say is quote unquote less risky, although they are starting to fail now as well. So anyway, let's get into this and see what it is. So there's all these acronyms, and I think they're designed to just purely confuse people, but just read past this. So CPPIB announced today that its wholly owned subsidiary, CPPIB Credit Investments, is broadening its portfolio through new investments in equity tranches of collateralized loan obligations, CLOs, alongside experienced CLO asset managers. And basically, this was in 2018, so 6 years ago. And obviously, they've probably ramped up investment in these products massively. We know that the amount of money being invested in CLOs really started to increase over the pandemic because of the low rate environment, the just ridiculous casino environment that was created from the massive unprecedented stimulus that was done in Western countries. But these CLOs are particularly dangerous because a lot of them are backed by commercial real estate. Now, the funny thing is, these managers, these CLO managers that they point to, are meant to be actively managing the portfolio, diversifying the portfolio. Yet when you look at some of these things that are coming out now, they don't look very diversified at all. And it kind of reminds me of in The Big Short when Mark Baum sits down with that guy in that sushi restaurant, and basically the guy, he really isn't doing that much, and he is a CDO manager. So it gets really interesting here. CPPIB Credit's initial partnership in CLO equity investing will be with Sound Point Capital Management LP, a New York-based credit-focused asset manager. CPPIB will be investing $285 million in a newly established investment vehicle used to purchase equity in Sound Point CLOs over the next several years. So obviously 6 years on, and they were basically committing to investing in these CLOs back then. And this is Canada Pension Plan, guys. This is the pension plan that everybody is forced to pay into in Canada. And I think it's just outrageous that people are forced to pay into this. I mean, I do understand that on the lower incomes, yes, you probably need to make it mandatory in order that people pay into a pension, or they're not going to do it just because they can't afford the way to live. So they're going to prioritize other things instead of putting money into a pension. But you know, if you're earning, let's say, over $100,000, I really think that you should be able to opt out of paying into these stupid pension plans, which quite frankly, a lot of people could just manage better in a self-directed account themselves. But again, I think this more has to do with the fact that government buys influence through these investment vehicles because they own a lot of equity in these companies that they are trying to regulate. But anyway, CMBS buyers face first Europe AAA loss since credit crunch. B of A sees sales of shopping centers generating a shortfall. UK regional malls have suffered from online shopping and the pandemic. And I can tell you that before the pandemic, I mean, UK malls and shopping centers were already suffering. It just accelerated that. So investors in what was the safest part of a loan backed by UK shopping malls are facing losses, possibly the first such impairment since the global financial crisis, according to Bank of America. Now, when we get into this, it's going to blow your mind because once again, you're going to think, what are the ratings agencies doing here? So the anticipated losses in Europe follow a hit to investors in a US CMBS last month. Buyers of the AAA portion of a note backed by the mortgage on a building in Midtown Manhattan got less than 3/4 of their original investment back after the loan was sold at a steep discount. It was the first such loss for investors in top-rated bonds backed by commercial real estate since the credit crunch, according to Barclays. So what's really interesting about this is obviously it's a AAA rated, and you're thinking, well, if it's AAA rated, how on earth are they selling it at a discount? I mean, according to the CLO managers, according to the people who sell these products, there is only a 1% chance that things like this are going to happen. happen. Yet we're starting to see it happen, and we're starting to see it happen more frequently. So that does raise the question again of the ratings agencies. What is going on at the ratings agency? And it just is mind-boggling, because literally this one backed by UK shopping malls was literally assessed by the credit ratings agencies in April. So as recently as April, ratings agency Morningstar DBRS estimated the value of 3 retail properties underlying the loan at £50.4 million, which set the loan to value at 125%. However, the agency noted that there was uncertainty around the outcome of the sales process against the backdrop of challenging market conditions. The decline in the maroon property values has been striking, Bank of America wrote in a note to clients on Wednesday. A shortfall would represent the first CMBS initially rated AAA to take a loss since the financial crisis in Europe, to our knowledge. And just think about it, guys. CMBS, all that is mortgages on commercial real estate. When you hear CMBS, just think mortgages on commercial real estate. When you hear CLO, think a securitized product containing mortgages, which is so-called backed by assets. But it's becoming highlighted by even this article that the valuations and the loans took out on these properties are ridiculous. You've got them lending more money than the property is worth, and then that mortgage goes into a CLO, and guess what? Even the AAA top-rated tranches, which aren't meant to be taking losses, once again, they're meant to have that 1% chance, they are being impacted. And guess who owns those? People like Canada Pension Plan, people like Ontario Pension Plan. All the pension plans around the globe invest in these financial products, and these financial products have boomed over the past couple of years. And there's a struggling bank in Japan, which Jeff Snyder has been pointing out, which is now investing heavily in CLOs because it's actually running into problems, which is again just a sign of how bad things are. And another thing that you want to bear in mind is the banks that package these CLOs, like JP Morgan, for instance, they have to have them on their books for a couple of months whilst they create these securities. So there is a massive risk there that if things really blow up and CLOs become worthless, then guess what's going to happen? All these banks, once again, it's going to be musical chairs, because all these assets that they're holding to create these securities on their books will become worthless again. And it's essentially, but the real estate landscape is being shook right now, and it's not just commercial real estate. So Ashcroft Homes defaults on $6.5 million loan, 3 properties in receivership. So this isn't even commercial real estate, but Ashcroft Homes has defaulted on a $6.5 million loan, sending 3 of its Richmond Road condominium properties into receivership. So this is in Ottawa. Tenants of the 3 properties were issued letters earlier this week indicating that their landlord had gone into receivership. The letter from the receiver, BDO Canada, came with a court order attached. Court documents show that Ashcroft Homes failed to repay the $6.53 million loan to Duca Financial Services when the loan matured in November 2023. The 2 parties subsequently entered into a forbearance agreement. Doesn't this sound kind of similar to what we're seeing with the can kicking that is going on when it comes to the retail clients? And they are basically just kicking the can down the road with these fixed payment variable rates. And I've said that that's making the problem even worse, and it's more and more likely that they're never going to repay that loan. Well, it's a similar thing with Ashcroft Homes. You know, they were in this forbearance agreement, and look what happened. They didn't repay the debt, and they're now in receivership. So it's very interesting what's going on. And then it's crickets, how sellers are getting creative in the slow housing market. So again, you've got these massive condo projects that rely heavily on what? They rely heavily on financing from the big banks, and they're struggling really bad. In particular, the condo sales are really tanking. So a flood of listings in many housing markets is giving buyers who can qualify their pick of the litter, and is forcing some sellers to get creative to land a deal. A glut of condos in Toronto, for example, means some sellers have to put out unorthodox strategies to land one of the few prospective buyers in the market. This is exactly what John Flynn and I talked about on that interview, and I'll link it at the end, where he was saying that the sentiment has shifted and the deer in the headlights expression that he would see on buyers' faces is now on sellers' faces, where they're like, how much of a loss am I going to have to take on this? So very interesting and very telling of what's going on. So Develle Morrison, a real estate agent in Toronto, says that one of her clients recently deployed a reverse offer to land a sale on a condo. As Morrison tells Global News, the unit had a few interested buyers, but the parties couldn't settle on a price. After another 3 weeks went by, she suggested her client go back to the buyer whose offer they had initially rejected and suggest that they would now be willing to entertain a lower price. So it's very interesting what is happening in the Canadian housing market, especially the condo market, but it's not surprising because when you look at affordability in Canada, the condo is this line here, and this chart's from RBC. It's on Better Dwelling. I'll link it in the description. But you can see how during 1991, this got to similar levels as it actually is right now, funnily enough. Isn't that a coincidence? But you can see as a percentage of median household income, condos have really kind of been around that 30% mark, has been the historic norm, and where it's going to have to get back to reality. I would argue even less than that, because the condo fees have gone up so much and they're so excessive now that you have to include that. And they're not including that. They're just talking about the ownership costs in terms of the mortgage payment here. So very interesting and worth noting. And then if you look at what's happened with single family homes, and this is the insane bubble that Canada's been in, you know, single family homes taking up 40 to 50% of the median household income is completely insane. And even if you exclude the mortgage payment and just draw this line across here, you know that ownership costs, property taxes, all these other things have gone up substantially for homeowners. So it's not just a case of, oh, interest rates have gone up and as soon as they come down, everything's going to be okay. We know it's far more complicated than that. And Canada was in a bubble before that. I mean, you've now got it at over 70% of the median household income. Obviously, nobody can afford this. It was unaffordable before, but maybe people were able to qualify. But now with the increase in ownership costs, it puts the real estate market really in the implosion zone. And that's exactly what's happening. And you have to remember that real estate in Canada represents 40% of Canada's economy, which is completely insane. And it's the highest in the G7, as it says here. And this is old, by the way. It says the next closest is Germany, which is around 30%. So Canada's reliance on its real estate bubble is ridiculous. You see, what's happened since 2008 is basically the facade of the economy has been the housing market. So basically the housing market and the population growth that we have seen has basically put a curtain in front of the economy. But when you peel behind that curtain, you realize there's just a skeleton there of an economy, because the economy has been decimated by red tape, regulation, oligarchies, lobbying, just all the things that you see with crony capitalism countries like Canada. And basically that is the major issue here. And I find it kind of annoying and also funny that Pierre, who is the opposition, he's going to be the next prime minister. And yes, he's going to be better than Justin Trudeau. But that guy is coming out and saying, we're going to have a carbon tax election. I'm sorry, but carbon tax is the least of Canada's worries. It really is the least of our worries. Why isn't this an immigration election? Why isn't this an election about the economy? I mean, it seems weird to come forth with that message and say, we're going to call an election about this tax, which once we get into power, we'll just, repeal and cancel within a couple of months. And then what after that? So I find that very interesting. And I think it just shows that he's not really going to change much. Much is going to stay the same until until we get to a point where people are so fed up and upset with both established parties, the Conservatives, the Liberals, and also the NDP, that they vote for something completely different. Because that's what it's going to take. People keep asking me what's the solution here. There's no quick solution. Unfortunately, the solution is going to be decades of pain in order to get to a point where people are so fed up and so sick and tired that they actually vote for something that is different from the status quo. I mean, after all, a lot of the people in the Conservative Party were in the Conservative Party in the Harper era, and that led to Justin Trudeau, who we now have, being elected. So just think, are they really going to change how things are going? I don't think so. So anyway, guys, I want to thank you so much for watching this video. If you've enjoyed this video, check out this video. It's an interview that I did with John Flynn, and I will see you in the next one. Take care.